Today, we'll be exploring and defining what is a bond. A bond is an investment in the form of a debt security. So, to further understand this, we'll be explaining bond and defining it into three difficulty levels. Explaining it to an 8-year-old. Think of bonds like lending money to a friend. Your friend promises to give you back the money after a certain time, and while they may have your money, they pay you a little extra as a thank you for lending it to them. For an high school graduate, bonds are like IOUs issued by companies or governments. When you buy a bond, you're essentially lending them money for a specific period. In return, they promise to pay you back the original amount, which is the principal, when the bond matures, along with some extra money, which is the interest, as a thank you for lending them the money. Explaining it to someone who has PhD in economics or finance, bonds are financial instruments classified as fixed income securities, representing debt obligations issued by various entities. This includes governments and corporations to raise capital. They are an integral component of capital markets, facilitating the flow of funds between borrowers and lenders. Understanding bonds involves delving into their key attributes, valuation, risk assessment, and broader economic implications. So here are the types of debt securities under bonds. First, we have treasury bonds. These are long-term debt securities issued by the government. They pay periodic interest to investors as a fixed rate and repaid upon maturity. Treasury bills, however, are short-term debt instruments issued by the government to raise funds. Investors purchase T-bills at a discount to their face value and receive the full face value when the T-bill matures. And of course, we have the corporate bonds, which are bonds issued by the corporate in different specific types and formats. So to further define and compare the specific bonds that we'll be discussing, we have here a table which explores each aspect of the debt securities to be discussed. So as you can see here, as for the issuer, treasury bills and treasury bonds are issued by the government, while as corporate bonds, as you might guess, are issued by corporations. For the maturity, treasury bills are short-term debt securities that usually only limits up to 1 year. For treasury bonds, these are long-term bonds, typically 20 to 30 years. Corporate bonds, however, varies and it typically is from 1 to 30 years. As for the interest or the coupon, treasury bills has no fixed interest and will always be sold at a discount. For treasury bonds, these are fixed interest payments which are called coupons. For corporate bonds, these are fixed or variable interest payments depending on the format on the company. As for the risk, we can see here that the risk of treasury bills and treasury bonds are very low because, of course, they are backed out by the government. And for the corporate bonds, these varies on the company's credit worthiness. As you can see for the market, treasury bills and treasury bonds are active secondary market investments, also with the corporate bonds. For the liquidity, you can see that treasury bills and treasury bonds are high, and corporate bonds are moderate to high, depending on the risk. So, how and where do we buy bonds and treasury bills? All right, if you can see here, the treasury bonds and treasury bills are usually sourced from the Bureau of Treasury. And here you can see the list of primary dealers, which are banks primarily, because they are the ones who can be inquired upon to receive bonds and bills from the government. And of course, this is backed up by the Securities and Exchange Commission. So if you can see here currently, we have 37 lists of banks that you can reach out to, or you can definitely make a transaction of having bonds or treasury bills. So as for the market makers, let's define them a bit. Brokers and firms, of course, can make money when customers buy and sell stock through commission. However, this is not the only way for various market participants to make money from the sale of assets. A market maker is an individual participant or member firm of an exchange that buys and sells securities for its own account. The goal of market makers is to add liquidity. The concept heavily revolves around a bid price and an asking price. Here is a sample of a treasury bills offering for PNB. If you can see here, the treasury bill is discussed primarily and of course with a minimum amount as specified. Also, PNB justifies why you should invest treasury bills through them, and it also includes the features. For inquiries and for indicative rates, you can send an email to the provided PNB email address. Here's another example of RTB or Retail Treasury Bond, which is endorsed by BPI. You can see here that they have a brief overview of the minimum investment, interest rate per annum, issue and redemption price. Of course, the interest payments are deployed quarterly. If you can see here as well, we have what we call bonds.ph. The bonds.ph mobile app was launched by the Bureau of Treasury in partnership with Union Bank and the Philippine Digital Asset Exchange, or the PDAX. Some of the bonds.ph features include the minimum investment to be 5,000. There is no bank account required. This is accessible 24/7, and this can be used by OFWs and Filipino investors abroad. Individual investments accounts are only supported as of now. There's no support for joint accounts at the moment. You can cash in through your debit card, your bank deposit, online bank transfer, and also e-wallets. A good talking point is that if you're keeping most of your money in a bank, it is recommended to invest them in treasury bills. Apart from having a particular yield and return than having your funds in a savings account, you're also helping the government in terms of projects and funding because they are using the money to fund multiple government initiatives. Here we see a sample of a treasury bill which is awarded by the Bureau of Treasury, and we see here samples of tenor and average rate. So be able to understand this further, let's have a sample computation. Investment is 100,000 and the discount rate is 1.649% per annum. For the tenor of 31 days, there's no interest payment, of course, because this is sold at a discount. And so what we can see by the formula is that our gross price would be 99,583.17. And so it would require us to invest upfront with the value of 99,583.17, and the maturity of that amount will be 100,000 on the 91st day. Here is a sample of a treasury bond. Sample computation would be 100,000, and of course, treasury bond are on coupon rates, which is on 2.875 per annum. The tenor is 10 years, but the interest payment is paid on quarterly. So if you can see on the timeline, for 4 quarters in a year, you will be paid 718.75 pesos, and that is 2,875 per annum for 10 years. Of course, we see here a table so to define how much can you earn from investing in corporate bonds. All right, so primarily, if you can see here, in order to estimate the potential income, the table below shows interest earned for a capital of a million pesos over a tenor of 10 years. The interest range from 3 to 8%. Amounts also reflect the 20% capital gains tax. However, on the last two rows, you'll see the gain percentage, which is the result when you divide the last balance and starting capital. CAGR stands for compounded annual growth rate, which describes how your money grows if compounded. It's a useful figure when you want to compare other investments that grow over time, such as time deposit, savings account, etc. Defined here are the basic requirements for the deployment of a treasury bill or treasury bond. So if you can see here, they need two valid IDs, tax identification number, and of course, documents that provide bank account information. You also have required to have a minimum initial investment. And once initiated, you'll be provided with the appropriate forms to complete and will be given instructions if other additional documents or requirements will be needed to submit. All right. How about corporate bonds? When a corporate bond is within offer period, you may want to read more about the details. More often, you can get information through the business pages of major broadsheets and business news channels. You may also want to visit the company's page, their profile on the Philippine Stock Exchange website, and other online sources. If you weren't able to take advantage in purchasing corporate bonds during its offer period, you may want to opt to acquire them through a secondary market. You will need to open an account through any of the fixed income brokers on Philippine Dealing and Exchange Corporation, PDEX, duly licensed by the Securities and Exchange Commission. Of course, the easiest way to invest in corporate bonds is through bond funds. These are pool of money from the investing public that is managed by an investment house purchased in both public and private. However, we have some things to remember here in terms of minimum amounts, and they are indicated as is. This, of course, applies to corporate retail bonds, retail treasury bonds, and treasury bills. Of course, as mentioned earlier, the easiest way to basically regulate your fund is through a fund manager under the premise of a bond fund. Now, mutual funds, which incorporates bond funds, will be discussed primarily in a separate video with certain depth. As we can see here, let us try to relate and compare the pros and cons. Listed are the pros and the cons. In terms of stability, bonds are generally considered less risky than stocks. They offer more stable returns and can be a good choice for investors seeking capital preservation. Diversification is adding bonds to a portfolio, and it can help diversify risk. And it helps also to balance out the potential volatility of other investments like stocks. For capital preservation, in most cases, bondholders receive their principal back when the bonds mature, helping to protect their initial investments. Of course, credit quality. Government bonds are considered very safe due to government backing, and highly rated corporate bonds also offer relatively low default risk. Some of the cons include lower potential returns. Compared to stocks, bonds generally offer lower long term potential for capital appreciation. This somehow limits the potential for significant wealth growth. Interest rate risk. When interest rates rise, the value of existing bonds can decrease, leading to potential capital losses for investors who want to sell before maturity. Of course, there's a risk for inflation as well. Inflation risk is if inflation rates exceed bond coupon rates. The purchasing power of coupon payments and principal at maturity may erode over time. And of course, limited growth potential. While bonds provide income, they lack the growth potential that comes with equities or stocks in a growing company. This is all for the bonds. Other investment will be discussed in a separate video. Thanks for watching.